Hi, this is Franco with Wisdify, and in this video, we're going to be talking about the weighted average cost of capital and how you're going to use it in mergers and acquisitions analysis. So a lot of people actually overlook the weighted average cost of capital and why we use it in the first place. But hopefully after this video, you're going to know what it is, you're going to know why it's used and when to use it in your career as an amazing mergers and acquisitions professional. All right, so let's get started. What is the weighted average cost of capital? To answer this question, we really have to go back to our basics. And if you're a CPA, you know this by heart. Our assets are equal to our liabilities and our equity, right? In a visual representation, we have assets that we need to run our business. But where do these assets come from? They don't just come from thin air, or they aren't just gifted to us, right? These are acquired partly from debt and partly from investments from owners, right? Our liabilities are the representations of our debt, right? They come from creditors, and our equity comes from our investors or owners. And they don't give this out for free. If you had to ask yourself, why would you invest in a business? Whether you're lending money or actually investing your own money to become part owner, it's definitely because you're looking for return, right? If you're giving out liabilities, or in other words, you're a creditor that is lending money, you're looking for interest. On the other hand, if you are an owner, you're going to be looking for dividends, but that's not all, because you're also looking for capital appreciation, right? And again, these are the returns that you're looking for. When you're starting a business, these are the returns that you have to provide to your creditors and business owners, right? So what is the concept of weighted average cost of capital? If you have interest and you have to give dividends and capital appreciation too, how do you know how much do I need to earn to be able to give interest and then dividends and capital appreciation as well, right? So you're looking for the minimum amount of return that you should be able to provide. And how do we answer that? It's a really simple equation. So we look at the cost of debt and the weight of debt. What is this? Basically, the cost of your interest is usually your yield rate, and you just multiply this by the weight of debt, which is the ratio of debt compared to your assets. And it's the same line of thinking with equity. You have to get the cost of equity. So again, this is the dividends and the capital appreciation that you're looking for. So there's actually more to compute here. You can compute for the cost of common equity. You can compute for the cost of preferred shares. You can compute for the cost of retained earnings as well. So now we multiply that by the weight of the equity, and this is just the proportion of equity to total assets. And we add those two figures together. It's like we're getting the weighted average of those two costs, the cost of debt and the cost of equity. And that's how we get the weighted average cost of capital. All right. So to practice, let's check out this data set. We have the value of debt and we have the value of equity here. So together, that gives us total assets of around $250 million. So I have the cost of debt and the cost of equity as well, and I have a tax rate. So how am I supposed to compute for my weighted average cost of capital? It's really simple. When I get the weight of equity, again, this is just the proportion of my equity to my total assets. So I echo that. And I can just drag this down because the weight of debt is the ratio of my debt compared to my total assets, right? So that's 100,000 divided by 250,000. I get 40%. Now, what's left for me to do? The cost of debt and the cost of equity have already been given to me. And for the cost of equity, all I need to do is multiply 12% by the weight of equity of 60%, right? And for the cost of debt, what I need to do is I'll multiply my cost of debt, and you might be excited. You might be saying, just multiply it by the weight of debt. But there's something that we need to do before that. And when we're multiplying the cost of debt, we have to understand whether this is post or pre-tax, because interest is something that is taxable. And when it's taxable, what happens is you're going to have to pay 10%, but this is going to go through taxes. So you have to multiply this by 1 minus the tax rate, right? You have to show the effects of it after tax. And once you get the post-tax cost of debt, that's the only time that you can multiply it to the weight of debt. And you're supposed to get 3.2. You just add these two figures together, the weighted cost of equity and the weighted cost of debt, and you have your weighted average cost of capital of 10.4%. It's that simple. Okay. Now you might be thinking, what do I use weighted average cost of capital for? Now I know how to compute it. It's a lot simpler than I thought it was, but why is it really useful? Again, weighted average cost of capital represents the minimum amount of returns that you need to earn to satisfy both your lenders and your business owners, right? It's what you're going to use to assess investment viability and risk. So if we go back to our data set here, we have a weighted average cost of capital of 10.4%, right? And let's say that the returns of a certain project will only give me 9%. So how do I use the weighted average cost of capital in this scenario? If I need to provide at least 10.4%, why would I ever settle for anything below that? So any project below this will automatically be rejected. This 9% project, get it away from me, right? I'll only accept projects that are above 10.4%. So that's one thing you can use. So if you're running models and you're computing for something like, say, the internal rate of return, and internal rate of return comes back as 13%. Do you accept the project or do you reject the project? You're definitely going to be leaning towards accepting the project because it is greater than the weighted average cost of capital. So that's one application. Another one is discounting future cash flows. So if you're using weighted average cost of capital, we know that it is the minimum amount of return that we should use. And in most cases, let's say we're given a cash flow or a set of cash flows. When we're computing for something like the net present value, the discount rate that we're going to be using is the weighted average cost of capital. Because again, it is our best estimate of the returns that we need to provide. So you can start off with a weighted average cost of capital. And I don't really mean that this is the flat rate that you'll be using all the time, because maybe you also need to account for something like a risk premium. Maybe this specific project is much riskier, so you have to add 3% as a premium, right? But either way, this now becomes your discount rate when you're computing for your NPV. If we're going to do that together, I just use my NPV function here and specify this as my rate. These is my cash flows. And of course, I want to add this by year zero cash flows. And I see that, hey, it looks like it's not going to be a profitable investment because my NPV is less than zero, actually negative 142,000, which means I'm going to lose money if my company invests in this project, right? So that's the second way that we use weighted average cost of capital. And the last way that you can use weighted average cost of capital when you're doing mergers and acquisitions is using it to find the optimal capital structure. So what does this mean? Now, when we're doing computations for the weighted average cost of capital, you can see that the value of equity and the value of debt were already given. But now, especially since we have the solver tool here, if you have the solver tool or you have the solver add-in, you can use that from your data tab. And why would we really need it in this case? Now, weighted average cost of capital, again, is the minimum amount of returns that we need to provide. But this can change if the cost of debt and cost of equity stay constant. You can actually play around with this by changing the ratio of equity and debt that you're putting into the business. So let's say that instead of 150,000, I've put 125 million. As you can see, just by changing the composition of our assets, we were able to reduce our weighted average cost of capital, which means that the costs of financing are lower, even if it's just by 0.4%. Now, you don't need to do trial and error here over and over again. We have the solver tool. And what we can do is we can specify this cell containing the weighted average cost of capital. And we can say that we want to find the minimum possible value for that by changing these two cells, right? And once we press solve, okay, it turns out that we can actually lower our cost of debt, right? We can actually lower our weighted average cost of capital if we finance the whole project using just debt, right? So that's a cool thing that you can do, but please do take note that this isn't a realistic scenario, because the more that you finance with debt, the more risky your investment becomes, and you have to add more of a premium to reflect that risk. So your weighted average cost of capital is actually still going to be higher. The optimal weighted average cost of capital will surely be a mix between debt and equity, but you'll find that out as you go along. That's pretty much it for our video on what weighted average cost of capital is and when to use it. I hope these tips really helped you. And again, this is Franco from Wisdify, and this video was about understanding weighted average cost of capital for mergers and acquisitions.